Hello everyone, welcome to today's video. In today's video, we will be covering the basic idea of portfolio under the study unit portfolio management. So it's a vast concept. In this video, we will be covering only the basic concept. So stay tuned to the set of the videos which we're going to upload under portfolio, because we will be covering the portfolio theories and also the practical sums in the subsequent videos. As we used to, our set of videos where we will be having the checklist of concepts which will be discussed in the video, which comprises of 7 points, covers the concepts of portfolio and what is portfolio management, then what are the types of portfolio management and what tasks involved in portfolio management, the objectives of portfolio management, the basic principles of portfolio management, and finally we will be closing this video discussing about the factors affecting the investment decisions under portfolio management. Let us discuss about the very first point, what is portfolio. Before jumping into the financial aspects of portfolio, let us first know what is the general term of portfolio. A portfolio typically refers to a collection of assets, investments, or projects or samples of work that represents the skills, achievements, or diversity of an individual, or it can also be an entity. So basically, in different contexts, it can relate to a financial investment if it comes to the assets or investments, or it can relate to a art, or it can also relate to a design, or it can relate to writing, or it is a combination of various accomplishments. Suppose in your screen you're seeing a photographer. So when it comes to a photographer, his portfolio will be different areas under the photography, such as wedding, wildlife, corporate events. So when he defines he is a photographer under which he will be having a set of different skills, collectively he is calling as photograph, but within it there will be a wedding photography, a wildlife photography, or a corporate events. Similarly, under different context, it is applicable for art, design, or any area of any subject. Here, since it is a financial management videos, we are supposed to learn what is a financial portfolio, right? Yes. So what is a financial portfolio? So a financial portfolio is a collection of assets held by an individual or an entity with the goal of achieving specific financial objectives. Here, financial objective is having a more emphasis. Let us discuss about it at a later stage. As of now, financial portfolio is a collection of assets. So wherever I'm going to mention a portfolio throughout this video, the subsequent videos, we are referring to the financial portfolio, and is nothing but your collection of investment. So what are the types of investments here we are talking about? It can be a stocks, it can be of bonds, it can be of mutual funds, it can comprises of exchange traded funds, or it can even be your real estate investment trusts or certificates of deposits, your saving account, even your fixed deposits which will be covered, your commodities, and latestly we are having this cryptocurrencies also, and your cash and cash equivalents. So the collection of investment is nothing but all the baggage which contains of all these items. But there is no mandatory that all these items must be in your baggage, but a collection of investment. Not pointing to one particular investment, but collection of investment. And this collection of investments is dependent on investors' income, budget, and convenient time frame. Suppose I am an investor who are starting my investment in early stage. Based upon certain factors, my collection of investment will be limited, and based upon my budget, it might be expanded, and also based upon the age factors, there will be a different proportion for this collection of investments. So let us move further. Let us just have some deep idea about these funds. So we all know what is stock. Stock is something, a shares of ownership in a company. To put it in an example, owning stocks of technology companies like Apple or pharmaceutical companies like Sun Pharma. And secondly, bonds. When we talk about bonds, it is nothing but the debt securities that represents the loans to a company or government. Also, we are having mutual funds. So these funds are the pooled funds. Instead of focusing on a one particular industries or entities stock, we are just focusing on the pooled funds, where we will be investing in diversified portfolio. And moving further, exchange traded funds. What is an exchange traded fund? Similar to mutual funds, but these funds bonds or traded on stock exchanges. And real estate investments trust were company that own, operate or finance income producing real estates, REIT. Examples include equity, residential, etc. And certificate of deposits. So these are the time deposits after offered by banks with fixed interest rates and maturity dates. And we are commodities. So here what does commodities means? Commodities involves holding of gold, silver, oil or agricultural products. And cryptocurrencies, the digital currencies, popular one Bitcoin or Ethereum. And also their portfolio involves cash. So usually when we just talk about portfolio, we might not include cash or cash equivalents, but that shouldn't be the case. So the collection of these investments is called as portfolio. So there's a long discussion here about the portfolio. So just to put it or fit in a two-line concept, portfolio is nothing but your collection of investments. And this collection of investment is nothing but your stocks, your bonds, your certificates of deposits, your cash and cash equivalents, cryptocurrencies, even your real estates and your commodities, etc. And also this collection of investments is basically depends upon the investor's income, budget and convenient time frame. When we talk about convenient time frame, so the investor may start to invest at a later stage of his life or even at his early stage of his life, or also he can take a break in between. So all these factors will be taken. So hope this is clear before moving on to the next topic. Let us go back to our slide, moving to the next concept. What is portfolio management? So what is a portfolio management? Okay, I know a portfolio is a collection of investments, but how I will select? So one who got the expertise to select those investment basket is known as portfolio manager, and the activity of doing it is called as portfolio management. Here it is nothing but art of selecting the right investment basket. So what should be the main objective of investment basket? The investment basket should contain minimum risk and it should provide maximum return. So portfolio management in single line, it is nothing but an art of selecting the right investment basket. For example, in my basket, there should be stocks, there should be bonds, there should be cash, there should be commodities, and etc. So moving back to our slide 1. So we already discussed about portfolio and portfolio management. Going to types of portfolio management. Okay, what are the types involved in this portfolio? And in between you also mentioned about a portfolio manager. Who is he? So let us discuss about this in the coming slide. So that first let us focus on the types of portfolio management. So there are 4 types of portfolio management. One is active portfolio management, another one is passive portfolio management, and we are having discretionary portfolio management and non-discretionary management. If you see, if these portfolios are taken care by an individual on behalf of the investor is known as portfolio manager. Widely, we used to call this portfolio manager by another term called fund manager. So what this person will do is, based upon our request, he will take the decisions for the funds which we have provided. So those decisions under portfolio are divided into 4 subdivisions. Active portfolio management, secondly it is passive, and discretionary and non-discretionary. So under active portfolio management, this portfolio manager will be actively involved in buying and selling of securities. Based upon the market performance, he will be buying and selling the securities. So main objective here is he will ensure that the individual or the investor or the entity who just provide the funds will get the maximum return and the risk will be minimized. Whereas under passive portfolio management, the portfolio manager deals only with a predefined portfolio design. So you won't be actively buying and selling. So there will be a predefined portfolio basket, so which will be having the certain percentage of this particular stock and certain percentage of this particular stock. There will be no active course of buying and selling of securities. Thirdly, it is discretionary portfolio management. Under discretionary portfolio management, as an investor, I will be giving the full rights to the portfolio manager or the fund manager to take decisions. So if the portfolio manager thinks, okay, this particular stock is not performing well, then he can just divert my funds to the other set of stocks. So he will take decisions when to sell, when to buy, or when to hold the particular stock. So full rights will be taken care by my portfolio manager. So for example, those individuals who don't have a financial knowledge, they can go for this particular activity called discretionary portfolio management. And under non-discretionary portfolio management, the portfolio manager can merely advise the investor what he can do, but he is not having any full rights to take his own decision. Example, if I'm just want to go under non-discretionary portfolio management, then my portfolio manager can advise me whether I should buy a particular stock or whether I should hold that particular stock, but he can't do it without my consent. The thin difference between the discretionary and non-discretionary is the full rights given to the portfolio manager to take decision, whereas under non-discretionary, the rights is not given, but the power of advising the investors to take the action is given to the portfolio manager. So these are the different types of portfolio management. Now let us go back to our first slide and check what are the concepts covered till now. So we have covered what is a portfolio, we have covered what are the portfolio management and what are the types of portfolio management. Now we will move on to what are the tasks involved in portfolio management. So before going into tasks involved in portfolio management, let us take an example. I just want to start an SIP. So I've just started an SIP. So this SIP is a collection of investments which will be handled by a portfolio manager or a fund manager who I have choose to. So now what this fund manager or the portfolio manager will be doing. So that will be discussed under task involved in portfolio. There are various tasks which will be carried on by the fund manager or the portfolio manager, but at the basic level we have 4 points which a fund manager or a portfolio manager takes care of. One is he will be taking decisions about the investment. Also, what kind of investment mix should be there? What kind of proportion of investment should be made for this particular individual investor based upon the time, based upon the age, based upon the market trend, etc. So the first concept is making decisions. So the task involved is he will first make the decisions based upon the investor's need, and he will be matching the investments according to the objective. So matching investments. So wherever we are going to come across the objective under financial management, especially stock market, share market, objective is always to minimize the risk and maximize the return. Next time when we just come across any objective, so it should strike your mind, objective is nothing but to minimize the risk and maximize the return. So the fund manager or the portfolio manager should take care of this particular point, that the individual investor and an entity should have a maximum return with a low risk, and the asset allocation for individuals and institutions. As we discussed, the investment mix, what proportion of investment should be taken care for this particular individual investor or an entity, and balancing risk. Suppose, let us take this an example. For different time frame, different sectors will work, will boom, new sectors will boom. For example, the current trend is towards the EV sectors, where the battery production for the EV sectors are at the peak. So the investors or the fund flow manager or your portfolio manager will do the market analysis, and based upon these analysis he will be shifting his investments towards the booming industry which will provide the maximum return to the customers, taking care of the risk. There are cases where there is a particular industry which is being booming for a particular decade and then there is no other scope for it. So the portfolio manager or fund manager should take care of these type of stocks and divert the investments towards the growing stocks, which will give benefit to the investor. So these are the tasks. These are the basic tasks performed under portfolio management. For time being, we are good to know these 4 tasks. One is taking decision. What decisions? About what? About the investment mix and policies, and matching the investment against the objective. So here, what is the objective? The objective is to lower the risk and maximize the return, and the asset allocation for the individuals and institutions, and finally the balancing risk against performance. Now moving on to the next concept of today's session. So we are going to talk about the objectives of portfolio management. So what are the objectives of portfolio management? So the objectives of portfolio management are listed under the 6 points. One is reduce risk. Always the investor's risk should be reduced. The investment should be made in such a way that the risk is reduced and the return is maximized. And the safety of principal. If I put any fund inside the market, if I just bring any fund, so that particular fund, the initial fund, the principal fund should be safe. Secondly, stability of income. There should be a stability of income. Investing should lead to a income stability and capital growth. Not even the principal should be safe. Also, the amount invested should give a good return, that I can have a capital growth. Then marketability or liquidity. Marketability or liquidity talks about I'm just investing in stocks. So how good the stocks can be released, how good I can sell the stocks, or is it about only having a stock? No, the portfolio should also consist some amount of cash or cash equivalents which will fulfill the need of certain requirements certain need of the investor, and finally tax savings. So tax saving aspects should also be taken care under the objectives of the portfolio management. So 6 points: reduce the risk, safety of principal, stability of income, your capital growth, marketability or liquidity, and tax savings. So let us check the remaining points. So the remaining concepts to be discussed is two. One is basic principles of portfolio management and factors affecting investment decisions. So let us just check what is the basic principles of portfolio management. So the basic principles of portfolio management can be subdivided into two. So anybody, either it's an investor, individual investor, or it's a portfolio manager or a fund manager, he should be aware of these 2 points. One is effective investment planning, the very base of portfolio, the effective investment planning, and a constant review of investment. I just made my investment, that's it, I'm going to forget about it. No, there should be a constant review of investments which you have made. So effective investment planning is made by taking into account of two items. What are those? One is fiscal, financial and monetary policies of government and RBI. So what are the new policies being released, what are the budgets is being released, all this needs to be taken care of. And the second aspect should be your industrial, economic, environmental impact and its impact on the industry prospects. So example, the release of carbon. So how it is going to impact a particular industry. If it's going to impact a particular industry or a particular sector, if there is any stock in my bucket which is going to be affected. So should I remove my stocks or should I hold it? So all this needs to be in mind even while making a new investment. So this is how the planning needs to be done. So the effective investment plan. Then after effective investment planning, we should also do a constant review of our investment. So this needs to be done on a continuous basis. So why we are doing this? We are doing this to identify more profitable avenues. So we are doing this to identify more profitable avenues for selling and purchasing investments. Whether to sell the particular stock at this point of time or I should purchase the particular stock at this time so that it will yield me some returns. Also, to just do this analysis, to do the constant review, we are having tools. Those involves assessment of your quality of management of the company, especially how good the company is being managed. Secondly, the financial and trend analysis of the company. So how this financial analysis and trend analysis of this particular company is going on, that needs to be analyzed. And also the security analysis needs to be done. Basic principles of portfolio management, in short, only two. One is effective investment planning to be taken care of, and second, constant review of the investments to be taken care of. Let us go back and check the very last point that needs to be covered in this video, that is nothing but factors affecting the investment decisions in portfolio management. Okay, so far we have just saw what is a portfolio management, the types, the tasks involved, the objectives. But what will affect my portfolio if I'm having a portfolio with me or I'm going to start a portfolio? What is going to affect my portfolio? Let us discuss in this. So portfolio can be affected by the following factors. One is types of securities. The types of securities you are choosing will affect your portfolio, and the proportion of investment. How much of proportion how much of weightage you gave to the equities, how much of weightage you gave to the low risk stocks, or how much of weightage you have given to government bonds, etc. So the weightage of your investments in your bucket will also affect the performance of your portfolio and the investment decisions. And the identification of industry. So you should identify which industry is going to boom or which industry is not going to work well. So all this identification needs to be done by based upon the financial analysis and also the identification of companies and the objective of portfolio. So as we discussed earlier, whenever there comes objective of portfolio is nothing but low risk, high return, and the timing of purchase. Let us consider this concept. The other person who is watching this video on the other side is being preparing for his examinations. Once his examination is over, optimistically, we just passed in this examination. Happy. So now the next stop will be our job or our business. So once it has been a time now, there will be a cash inflow. So this cash inflow will happen at a different point of time for each individuals. Also, another point of view is even though there will be a cash flow, the person or the individual exposed to the investment will be in a different stage. Some might start at an early stage or some might start at a later stage. So all these stuffs will affect your portfolio, the investment decisions. So if you start at the later stage, you have a less time to yield the return. So you don't have to gamble at this time. So what you have to do is you have to focus on the low risk stocks. So that's why it is being said wherever wherever your age limit is high, then go for low risk stocks. Reduce your investment percentage in the equity and risk tolerance. So if we just go into the market, we will be coming across these two terms: aggressive investor and conservative investor. Aggressive investors are someone who are fond of risk, not fond of risk, so they are fond of high returns, so they are willing to take risk. So these are aggressive investors. And there are conservative investors who don't want to take risk or want to take a very minimum risk or minimum to negligible risk. So these investors, accordingly, their returns will also be affected. So there are the risk tolerance will also affect the investment decisions under portfolio management. So what are the 7 types of factors affecting the investment decisions? Are the types of securities which we are choosing, the proportion of investment which we are going to manage, and the identification of industry, and also the identification of particular company, and the objectives of portfolio, what you wanted, and the timing of purchase when you just entered into this investment, and also the risk tolerance. So how good you are with the risk, how good you are like how willing you are to take the risk. So all this will decide the investment decisions. So we are about to close this session. Before closing, let us just go back to the first slide and just have a very quick revision of what we gone through under each of these points. First, we have just talked about what is portfolio. So portfolio is nothing but collection of investment. What is the portfolio management? Art of selecting the investment. What are the types of portfolio management? So we got 4 types of portfolio management. One is active, then we have passive, and then we have discretionary, and we have non-discretionary. Active and passive is about how active your portfolio manager is involved in selling and buying stocks for you. Discretionary and non-discretionary stocks about the rights which the investor provided to the portfolio manager. And we saw the tasks involved in portfolio, very basic tasks, the 4 basic tasks we saw, and objectives of portfolio management, and the basic principles of portfolio management. One is effective investment planning, and once it is done, constant review. And factors affecting investment decision. Various factors has been discussed. So what are the types of securities in your portfolio, your identification of industry and company, and your proportion of investments, your timing of purchase, your risk tolerance, etc. has been covered. So we are good to close the video now. So in the subsequent videos, we will be checking what are the portfolio management theories, what is the risk return concept. So that's all for the today's video. Thank you for watching.